All right, let's get right into it. Today, we are digging into the latest quarterly report from Fortress Minerals, a company that mines and sells iron ore. Their numbers for the second quarter of fiscal year 2026 just came out, and, well, they tell a really fascinating story. So, let's break it down.
And that story really kicks off with this central puzzle, something you actually see in business all the time. How on earth can a company sell more, bring in more cash, but then end up with less actual profit in the bank? I mean, it sounds completely backward, right? Well, that's the exact mystery we are going to solve by looking at their official numbers.
So, first up, let's tackle what I'm calling the revenue profit paradox. This is where we're going to lay out the basic numbers that set the stage for everything else that's going on.
And here it is, plain and simple. It's really a tale of two numbers heading in completely opposite directions. On one side, you have revenue. That's the total money coming in the door, which went up by a pretty healthy 6.4%. But then you look at the profit, the money that's actually left over, and wow, it nosedived, dropping by a staggering 56.7%. So how does this happen? Let's look at the actual dollar figures. Okay, first, the good news. Fortress Minerals pulled in over $16.5 million in revenue this quarter. And according to their report, the reason is simple. They just sold more stuff. The volume of iron ore they sold went up by over 8%. Now, the price they got for each ton was a little bit lower than last year, but selling that much more was enough to push the revenue up. So far, so good, right?
But then we get to the bottom line. After everything was paid for, the profit for the quarter was just under $2 million. And that's where you see that massive 56.7% drop. So you start with 16.5 million, you end with less than 2 million. This is the heart of the paradox. So where in the world did that other $14.5 million go? Well, the answer really comes in two parts. The first part of our answer is what I'm calling the rising cost story. And this is a simple, kind of painful reality that it just got a lot more expensive for Fortress Minerals to run its business this quarter. Let's break down where those costs came from. And you can see here, this wasn't just one problem area. Expenses went up pretty much across the board. The cost of sales, that's the direct cost of actually mining the ore, jumped almost 42%. Selling and distribution, getting the ore to customers, that went up nearly 10%. Other operating expenses, things like maintenance and employee benefits, up 16%. When all your costs are climbing like this, it just puts an intense squeeze on your profits. And this chart really illustrates the single biggest factor. This shows the average cost to produce one single ton of iron ore. Last year, it cost them about $27.44. This year, it jumped to over $35.71. That is a 30% increase in their core production cost. The report says this is because of higher costs for things like materials, blasting, and drilling. So for every single ton they pulled out of the ground, their profit margin got thinner right from the start. That explains a huge piece of the puzzle, but it's not the whole story. So let's move on to the second part of the answer, and this one's a lot more strategic. We can call this planting seeds for growth. Because you see, not all of that missing profit just vanished into thin air. A big chunk of it was deliberately spent, invested, with the goal of making a lot more money in the future. So what exactly are they spending on? Well, the report leans out several huge long-term projects. They're building new processing plants at two of their key mines, which will eventually let them produce way more. They also bought a new subsidiary that came with valuable mining rights, and they invested in another company to expand their portfolio. So this isn't just about paying the bills. This is spending money today to build a bigger, more profitable company for tomorrow. And they are putting some serious cash behind this strategy. In just the first half of this fiscal year, the company has already spent a net total of $4.4 million on these investing activities. That number, it's pulled right from their cash flow statement, and it really shows you the scale of their commitment. They are absolutely sacrificing short-term profit right now for what they hope is going to be a much bigger payoff down the road. Now, whenever you see a company with profits dropping and spending shooting up, it's totally fair to ask a pretty important question. Is this sustainable? Are they putting the company's financial health at risk? So let's do a quick health check and take a look at their overall balance sheet to see if they're still on solid ground. And the answer, at least according to their own numbers, is yeah, they seem to be okay. Even with the lower profit, the company's foundations look pretty strong. Their total assets, the value of everything the company owns, actually went up to over $112 million.
Their total equity, the value that belongs to shareholders, also grew. And maybe most importantly, they have what's called positive working capital. In simple terms, that just means they have more than enough cash and other current assets to cover all their short-term bills. So they can afford to make these big investments.
So, we've pretty much solved the mystery of the revenue-profit paradox. It was a one-two punch of rising costs and a big, deliberate investment in future growth. Now, for the final piece of the puzzle. What does the future hold? Let's look at the challenges and opportunities, the headwinds and tailwinds facing the company.
The company's own outlook has this really insightful quote that frames the whole global situation perfectly. For years, China has been the world's biggest steel producer, but now they're hitting the brakes a bit. That's a headwind. But that slowdown is creating a huge opportunity for other regions, especially India and Southeast Asia, where steel demand is just booming. And that's a major tailwind, because it's exactly where Fortress Minerals is positioned to sell its iron ore. So, if we summarize the future, you get some clear pros and cons. On the pro side, they've just locked in new sales agreements for 1.2 million tons of iron ore over the next 2 years. That's a stable, predictable income stream. Plus, like we just saw, they're perfectly placed to serve that growing demand in India and Southeast Asia. On the con side, though, the weakness in China is still a risk for the whole market. And, a little closer to home, the report mentions that some of their exploration license renewals are currently on hold, which creates a bit of uncertainty. And that really brings us to the final big question. We've seen the whole picture. Here's a company dealing with higher costs, but at the same time making a massive, calculated bet on its own future. They're sacrificing profits today to build new plants and position themselves for a changing world. The question is, will it work? Will these big bets pay off and turn today's profit squeeze into tomorrow's powerhouse growth? Well, only time and their future financial reports will tell us that. Thanks for joining me for this breakdown.